Investment rule: don't let it fall. Hope when you should be afraid and fear when you should hope. Making decisions based on rules, not letting emotions affect investment decisions is an easy thing, but the fact that most investors in the market are very easy to make. Jesse Livermore, a well-known long-term securities investor, has made and lost millions of dollars on the stock market. That once concluded, only two types of emotions in the market are hope and fear. The problem is that you often hope when you are afraid and you are afraid to hope. So have we ever asked the question, why hope when so afraid and do the opposite? Hope to be afraid and afraid when you should hope. Usually on the stock market, when stock prices drop by 10%, 15% over buying prices and are entering downtrend, when the account is new at a loss and we are hoping the stock will rise again. We should be afraid because the account will probably face greater losses. The thing to do now is to sell stocks to avoid losses. Capital investors can quickly make a decision to get rid of them from the beginning, but because they are human, they often let their emotions dominate. We do not want to suffer losses, so just wait and hope, until this hole gets bigger and it is our account that has to pay dearly, even sometimes cut loss hit the bottom. So far, it's the number one mistake most investors have ever made. Under O'Neill, sell the stock immediately and determine the loss when the share price drops 7%, 8% from the time of purchase. Compliance with this principle will ensure that the account exists until the next day, so that at least there is an opportunity to continue investing in other stocks in the future. The fact also shows that, when holding stocks are on the rise and we are making a profit, only a few shakes in the market make us fear of losing the profit. So, we sold out too soon. The stock market is volatile. The achievements of professional financial investors are to look at the business cycle, or the trend of the stock, not by the session. Therefore, the stock price is in an uptrend and having a few corrective sessions in the support threshold is a very normal thing in the stock market. There is a study that shows that, regardless of investment in any field, most of the human brain will act on emotions more than reason, and the stock market is no exception. But the capital market does not know who we are? Exactly, the market doesn't care what we think or want to see what's going on. Human nature is often tied to the market, and emotions such as self-belief, fear, and greed always exist. The methods we can practice to practice personal investment avoidance are: set up buying and selling rules based on how the market works. We often see lawyers before making judgments will often analyze the past and use precedents. The more you understand the past, the easier it will be to recognize future opportunities. Each investor should set up their own buying and selling rules, find outstanding stocks and then apply an analysis model to them to make their own decisions. Instead of listening to the people around, the partial personal views, or rumors from then hastily decided to buy or sell the stock they are holding. Spending your free time understanding stocks that have been winning in the stock market will help us be more experienced and somewhat more successful in the future. In fact, analyzing successful stocks in the past also provides an overview of market prospects. Daily and weekly market fluctuations sometimes threaten both experienced investors. A comprehensive view of the past will help detect the future trend of the market, from one cycle to the next, creating great development opportunities for investors. Academic studies have clearly shown how much investors can get from valuable stocks instead of hot growth stocks and quickly cool off, especially when we control carefully quality. No matter what our investment method is, thorough research will help increase performance in the long term. Reanalyze the past mistakes. Investing in stocks is not like buying a car or a mobile phone. The stock market is a market that is constantly moving. Stocks are sold at their value at the time of sale. Most investors want to earn quick profits, but in reality this is very difficult. Those who step into the market will also encounter mistakes from emotional decisions. Instead of getting them the next time, we can devote time and be willing to analyze our mistakes straight. Candid and objective. Overcoming the weakness of emotional investment is a challenge and it requires extraordinary efforts to change investors. Always observe transactions on the stock market to learn. There is an invaluable know-how to easily analyze transactions, which are yearly. We mark on a chart the time of buying and selling all types of stocks. Resetting the question, why did I decide to buy stock at that time and then the stock has risen? In fact, this will help investors set up some new rules to avoid making mistakes in trading principles in the future. Applying all knowledge and experience when making decisions should not depend much on emotions. Many people do not know that they should buy, sell, or hold, and this uncertainty shows that they have no direction. Most people don't follow a proven plan, a set of strict rules or buying and selling rules to lead them in the right direction. When deciding to buy or sell, be alert and clear and use your own knowledge and reasoning like never before.